my loves, welcome and welcome back to my channel. Welcome back to Failed Bank Fridays on the Riggy Report. My name is Riggy, and I feel like it's a very ironic name for the Friday videos that I do, because like a bank literally failed today. So we're doing Failed Bank Fridays in real time with a bank that actually failed today, and that bank, if you have been paying attention to the news, is Silicone Valley Bank. And I'm just gonna get right into it. Basically, Silicone Valley Bank, as the name suggests, was a bank that specialized in Silicon Valley with venture capital firms and tech startups. Basically, when venture capital firms and venture capitalists would invest in these startups, they would get a big, nice, fat check. Then the startups would take that check to Silicon Valley Bank, because they really specialize in, helping startups get established. That was their niche, right? So if you guys remember, back in 2020, when everything was shutting down, the whole world was shutting down, the category of stocks that were doing very, very well was tech stocks. Zoom was up like 200%, Netflix was up 200%, Facebook, everything, because everyone was sitting at home. We didn't really have anything else to do, so everybody was on their phones, everybody was watching TV, stuff like that. So around that time, tech experienced a big boom. And the tech startups really profited from that. So Silicon Valley saw their deposits just explode during that time. And if you also remember, in 2020, interest rates were going down. Everybody and their mom in 2020 and 2021 was refinancing because borrowing was so cheap. But because interest rates were so low and borrowing was cheap, so were interest rates on savings account. And you walked into any big bank like in 2020 and early 2021, you weren't making anything on your money. Banks around that time were giving you less than 1%. You were not making any money on your deposits at a bank at that time. So that was a problem for Silicon Valley Bank, because they were getting so much millions and millions of dollars deposited into their bank, into their accounts. And these big VC firms and these big startups, they wanted a return on their money, because if I'm gonna put millions of dollars in with you, I want something back for that. And that's basically what their clients were expecting. So because of that, the situation around that time, it was very hard for them to put the money into any real safe assets that was going to give them a return, so they can keep their depositors happy. So what they did was, and I read an article that said that they took about 60 or 80 billion dollars, something like that, and they invested it in mortgage-backed securities. So they bought a pool of mortgages, and they were supposed to be getting the interest at the time. Now, in 2020, buying mortgage-backed securities for 1%, 2% was cute, when other banks were only offering like less than 1%. So that was a really good deal at the time. However, if you also remember, around that time, the housing market was going bananas. It was going crazy. You could not find any houses to buy, because whenever you were walking around, going to an open house, there were so many people. So house prices went up dramatically, because it was so cheap to buy. It was so cheap to buy a house. It was so cheap to finance that almost everyone and their daddy wanted to buy a house, their first home or a second or third home. So because of that, inflation skyrocketed, and the Federal Reserve, Jerome Powell, decided they wanted to raise interest rates. So what happened was, as the interest rates kept rising, the value of the securities that Silicon Valley Bank had was decreasing. Because why would anyone pay you money for mortgage-backed securities that are only giving 1%, when we can go get some right now that are giving 4%? So the value of their securities that they just bought like the year before was decreasing. But it was okay, because they didn't need to liquidate at that time. So everything was, kosher, cool. However, at the end of last year, 2022, if you guys remember, a lot of tech companies started doing a lot of layoffs. The tech companies were being squeezed. They were having a lot of issues, and they needed that money back. So they took Silicone Valley Bank didn't have the money to give them because they took it and they invested it in an asset that was now worth less than what they had originally paid for it. So they were in the negative by a lot of money. So what they had to do was liquidate everything. When they liquidated the mortgage-backed securities, you know, because it was now worth less than what they originally paid for it, there was a shortfall. There was money missing. So what they tried to do was sell stocks and of that bank to try to make up the difference, so they could, you know, give the depositors the money back. However, when they tried to do that, it kind of made everyone look at them sideways, because if you were, you know, a strong bank that was working in the way that you should be working, there would be no reason for you to raise capital. So because the depositors didn't feel safe with having their money at the bank, everybody started pulling their money out. Everybody started pulling their money out. Now, it kind of became making a bad situation worse, because if they already didn't have the liquidity to, you know, give the depositors their money back when it was just them before they got spooked, when everybody was trying to transfer out millions and millions of dollars, that really put them in a hole. And eventually they just didn't have the money to give anybody their money back. And then the FDIC had to come in and take over, and now they're completely shut down as a financial institution. So I see a lot of people, you know, talking about it, and a lot of people are making very great points in their videos. And now this could go both ways, because one thing I don't see a lot of people talking about is the possible repercussions for the entire like financial system here in the United States, because people are already stretched thin enough as it is. And when we think of Silicone Valley Bank, they're not a bank where it was just like regular people, me and you, could go in and open accounts. Obviously, they were for big institutions. They were a bank that catered to companies. And one thing about companies is that a lot of companies don't have cash on hand. A lot of them do rely on credit products, because a lot of times when you buy something from a company, they don't receive that money right away. Depending on their merchant processor, it might take them a couple of days, a couple of weeks to receive the money. But they still have to be able to pay employees. They still have to be able to pay for lights. They still have to be able to pay for rent. So they rely a lot, not only on the cash on hand that they have, but on things like line of credit, letters of credit from their financial institution. So now what happens is that a lot of these companies, a lot of really big tech firms had money at this bank, and now the bank is shut down. So not only do they not have access to their own money, now they don't have access to the lines of credit and the letters of credit that were keeping them afloat. So the problem is, this bank shutdown is going to affect companies that were completely healthy. Companies that unfortunately had nothing to do with it, that are now just stuck in a really bad situation. So now these companies that were running payroll through Silicone Valley Bank now have no way of paying their employees. They have no way of paying their invoices. They have no way of paying people that, you know, they owe money to. And they also have no way of receiving any money from anyone unless they had an account at a different bank. So if they had any, you know, outstanding payments that was going to come to them, they don't have any way of receiving it, which is absolutely insane. And it's going to cause like ripples across the market. And it's not clear how deep this goes yet, because when you really think about it, all of these banks and all these financial institutions, they're all in bed with each other. Like, they're all intermingled, and we never really know how deep it is until something like this happens and it exposes the cracks. What I'm personally really worried about is the businesses that are going to close, because as of right now, Roku just came out and said that they had millions of dollars, hundreds of millions of dollars, around 26% of all of their cash with Silicone Valley Bank. That's a lot of money. Imagine a business just losing 26% of all of its cash on hand in a day. That's insane. That's an insane amount of money. And a lot of people a lot of people in the media, they're saying, well, yeah, it was FDIC insured, you know, FDIC insurance, but FDIC only insures up to $250,000. When you have $426 million at a bank and it shuts down, what is $250,000? That's pennies. Pennies. This entire situation is absolutely crazy. I never thought I would be, you know, old enough to witness a bank run and a bank of this size collapse. But, you know, here we are, 2023. This entire situation is absolutely insane. Let me know what you guys think. Feel free, because I just got off work. Let me know what you guys think down in the description box. I would love to have like open communication with you guys, because this entire situation is insane. We just have to hope and see and cross our fingers and see what the government is going to say, what they're going to do, because regulators have already taken over the bank. It's just a matter of time. Today's Friday. We're just gonna wait until Monday when the bank opens up, see what happens. Anyways, that's all I have time for today. Thank you for watching this video. Let me know what you guys think down below. Have a great rest of your day.